I recently got a chance to run an options workshop with Lancaster University with the Finance Society. So here it is, here's that presentation. And nothing in this video is financial advice. I'm not a financial advisor. Always do your own research or seek out professional advice. So the agenda today is we want to understand what options are, get a background. We want to look at what exercise assignment means, intrinsic, extrinsic value. We want to look at the Greeks, implied volatility. And then I want to load up the broker as well, and then we'll actually have a look at the options chain. So you use them, pretty much everyone. Every market participant uses them at some point, whether it's for income, for example, pension funds, they would sell calls on their existing holdings. Retail traders, hedge funds, would use them to speculate. And of course, the market makers who, make the market. And so what are they used for? It's very flexible. You can use it for a lot of stuff. You can sell options to collect premium. Gives you a chance to trade volatility as well, because as there's sort of movement in the underlying, if the daily return is increasing, then the option prices rise as well. And options are very leveraged as well. So an option gives you control over 100 shares, as I'll sort of be going into detail. And probably one of the most notable part is it can be used as a hedge as well. So when you're buying puts, it's sort of like an insurance, and you have downside protection should the underlying go down. Dating back before, the options that we know today, the ones that are listed on the exchange, an option is more or less, it's a legal term. And really it's an agreement. And let's say me and Louis has a house that he wants to sell to me, and I want to buy a house that he owns, and we agree on a price of, let's say, £70,000. And this contract agreement has an expiration of, let's say, next year. And so Louis wants a premium. He's going to want a premium for holding the property on the market. And so we agree on a premium of £3,000. And come expiration time, the property value has gone up. I can exercise our contractual agreement and I can take ownership of the property. And so the gross profit, because of the difference between the price I paid and the current market value, is 20,000, and our net profit is 17,000 because you deduct the premium. So Louis would keep that premium regardless if I exercise the contract or not. Now, the options today that we know today is listed on the Chicago Board Exchange. And you can get options on pretty much any sort of instrument you want, stocks, on commodities as well, on bonds. And I know some people who made a profitable trade by buying puts on the 10-year as well, sort of joining in on the momentum. And then, ETFs and FX as well. So you have two types. You have a call and a put option. A call option gives the buyer the right to buy 100 shares from the option seller. And a put option gives the buyer the right to sell 100 shares to the option seller. Now, when the right to exercise is with the option buyer, and the option seller will be assigned on those shares, whether it's a put or a call. And so what does that mean? So if the option seller, if they hold the underlying, let's say they sell a call option, if they hold, let's say 200 shares of Apple, then if the option buyer exercises that contract, then those 100 shares will be deducted from their holdings. And if they don't own it, then they will be short those shares. So you can sort of see where the risk comes in. And then with puts, if you sell a put, then the seller will be assigned 100 shares because the put buyer is putting those shares to the option seller. But a lot of people are surprised to find out that it's almost rare that options are exercised, because more or less it's just sold back into the market, because any profit potential is just sold back into the market. Yeah, so as we mentioned, you buy a call if you're bullish on the stock, and you buy a put if you think it's going to go down. Now, as an option seller, you are inverse. So you're taking the other side of the trade. So that's why if you write a call option, you're bearish, and if you write a put option, you're bullish on the underlying. So for option prices, we use the term premium, and premium is composed of both the intrinsic and the extrinsic value. So what is the intrinsic value? The intrinsic value is really how much in the money is the option, right? So let's say we're looking at AMD today, and the strike price for AMD is 90. And let's say the stock is currently trading at $120. The intrinsic value of this strike price, AMD, $90, then the intrinsic value is $30. And it's the inverse for a put. So let's say the put strike price is $130. Sorry, let's say it's $150 and the stock price is $130. It will be in the money by $20. So that's the intrinsic value. Extrinsic value is sort of the most interesting part, in my opinion, about options. It's also known as time value, because sort of the further dated options are, the more time value it will have. And so before expiration, all options will have extrinsic value, and all options which are out of the money will expire worthless. Okay. So the Greeks, there's actually about a dozen Greeks, but these are the most notable ones. You have delta, which tells you how much the option value will gain for every $1 move in the underlying. And it can also be used as a proxy to tell you the probability that the option will be in the money. And you have gamma as well. So delta doesn't stay stagnant. Delta moves as well, which is how you get convexity, which is how you get exponential return, sort of that leverage that we were talking about for options. And so gamma tells you how much delta will change for every $1 move in the underlying. And then you have theta, which is the daily rate at which the option will decay. So for an option buyer, that's how much they're going to lose a day, basically, as the option is decaying. And for the option seller, that's how much they're making in profit every day. And then we have vega as well, which is linked to implied volatility and tells you how much value the option will gain for every 1% move in implied volatility. So we're looking at the payout graph here, and this will tell you what the profit potential is and how much money you can make depending on where the underlying is. So here for the x-axis, we have the stock price. So how much will the option value be dependent on what the current stock price is. And then on the y-axis as well, you have the P&L, i.e. how much you'd profit or lose depending on where the stock is. And then your break even is really the strike price plus the premium you paid. And so here we're looking at Apple. Strike price is $140. And the premium that we're paying is, well, the ask here is currently at $2.70 and the bid is at $2.65. So you would buy this on the market at $270. And so therefore your break even is $142.70. Okay. And this is reflected in the payout graph as well. Notice that once it reaches $142, we hit a break even. And so anything beyond that will be in the money. And this is when you start getting profitable trade. And so this P&L graph is currently at expiration. There's no any extrinsic value in the option. But now this is the option. This is the payout graph with extrinsic value. This is before expiration. And you see the dotted line is, as of today, what will the P&L be? And so if you notice, the option doesn't have to be in the money in order for it to be a profitable trade. You know, if Apple were to go up 10%, your P&L would be $420, you know, on your initial outlay of $272. Okay. And yeah, I mean, within, let's say, a couple days, this line would slowly start approaching the solid line, which is at expiration. And so it's really a matter of, are you happy to sort of sell the option back into the market and, you know, realize your profits, or do you think the stock will go higher, making your option more in the money? Now, being short a call is taking the other side of the trade, and the P&L is flipped. And if you notice, we are negative delta. So for every $1 move in Apple, you're actually losing this amount. So you see, if at the current price of Apple, for every $1 move, well, for every $100 move, because each option controls 100 shares, then you'll lose $23.93. And then gamma is the rate at which delta increases. And if you notice here, as sort of if the underlying were to be $135, delta would raise to 44 because of gamma, of course. And you notice as the underlying is going up, delta is rising and rising. The max delta can reach is 100, which would be, it would reflect for every $1 move, then the option will gain or lose in value. As well, I should also say that options have a multiplier, as we mentioned. So when you see the prices of like $2.70 and $2.67, that really means if you wanted to buy it, you'd have to pay $270. So again, that's because of the multiplier. And here we have theta as well. So since you're short, then you're making $3 a day. And theta increases as well as it approaches maturity, because sort of the daily decay increases. The decay of options is exponential. So an option will decay far quicker if it has 1 week until expiration versus sort of a year out. It decays at a much slower rate. So that's why option sellers sometimes prefer to sell weeklies or to sell maximum like a month out. But it differs with strategy. Now, going back to here, when you sell a call, you have undefined loss potential. You see the max loss here, undefined, because the stock can go as high as it wants, and you'll be short that stock. But now a way to hedge that is you would buy a further out the money call option. So the example we were looking at, strike price 140. If we buy a further out the money 150, then we cap our loss. And so you can see here the P&L, the loss is capped at 150. So the return to risk here is for every for about every $120 you make in profit, you could lose around $900 in this trade. Personally, I wouldn't go into this trade, but this is just an example. Okay, so a little bit more about write-in options. So when you sell an option, you collect premium. That premium that you sell it for to the option buyer, that's cash, that's deposited into your brokerage account. And as we mentioned, the fader, that's your figure telling you how much you're going to profit every day. And it can also be used alongside calls, as we showed with that spread. And the cons of selling an option, as we talked about, you have undefined risk. So you need to watch sort of what your exposure is. A lot of people get tempted when options are expensive, when there's a lot of volatility. People are tempted to sell premium and collect that cash. But you have to know what your exposure is. And of course, if you're short an option, then you're at risk of assignment. So you're at risk of the option buyer. Anytime they can choose, they can exercise it. But it is sort of a rarity, as you mentioned. So this is the option chain. This is what you'll see. Now this is just for the calls. So everything you see here is for the figures around the calls. You have your Greeks. You have your time value as well, which we said is the extrinsic value, and then you have the bid to ask. Okay, so if we look at the strike price of $120, look at the market value. Buyers are happy to buy at $955, and the sellers are happy to sell it at $970. Now breaking down the price here, so let's go for the 120 strike price. If you notice the time value, right, the extrinsic value is $650, and we know at the time Apple was at $123. Okay, so therefore we know that the intrinsic value is $3 because the strike is 120 and the current stock price is 123, and that's your premium sort of divided up into both intrinsic and extrinsic value. And if you notice, out of the money options, right, so anything above $123, its value is completely time value. So we look at the 130 strike price, you have your time value $525 and so on. It's only when you get into the money that the time value starts decaying and it's purely intrinsic value. Yeah, so this is just another example, and this is what you'll see when you sort of put an order through in your broker. Multiply of 100. So again, you're controlling 100 shares. Expiration here, July 16th for call option. Here's your delta, here's your gamma, and your theta. And a closer look at the Greeks, sort of with the spread that we mentioned earlier. And sort of the Greeks cancel each other out. So if you're long and you're short an option at a different strike price, we're buying, this is for AMD. So we're buying the 80 strike price. Okay, notice the delta is at 0.51. And because we're selling the 90 strike price, that deducts from our delta, that deducts from the rate at which we profit. And same thing with gamma as well. Our net gamma is 0.003. So that takes away from the convexity and that takes away from your profit potential. But a really good shout for one of these bull call strategies is the fact that it deducts from your time value. And so you're not as susceptible to time value. And as you can see there, the theta is, your net is, you're only losing 0.006 as opposed to your 0.044. But yeah, so these deltas would actually be times by 100 if you wanted to see the actual figure. But because sort of it's divided by 100, so you can see the prices. So same here, this bid and ask of $6 and $6.15. In reality, that would cost you $600 to buy. So implied volatility, it tells you how expensive the option is. If stocks didn't move, if a stock was flat, then there would be no implied volatility, there would be no extrinsic value. And so the more volatile the underlying is, the higher the extrinsic value or the implied volatility will be. And this was for the NASDAQ, the triple Q here. And the sell-off we saw last week, it's a spike in the IV. And so the figure you see here of 24%, that's an annual figure. So that tells you the market is expecting a 24% move in the underlying. And as you can probably figure out, the implied volatility is usually higher than the actual volatility. So that's an opportunity there for option sellers. And so here we're comparing the implied volatility of JP Morgan and Tesla. As you can expect, Tesla has a far higher implied volatility. JP Morgan, 28%, and Tesla, 66%. And that's because of the daily returns is far greater for Tesla. And as well, demands actually play a role as well. If you look at the volume, if there's more demand for an option, its value, its implied volatility rises as well. So as we mentioned, IV can rise with actual realized volatility in the underlying, but it can also rise if in times of uncertainty. So before an earnings for a company, you'll see IV rise. The options will get expensive because people are either hedging the existing holdings or people are speculating about where what the outcome of the earnings will be. Likewise, with any corporate announcements or events, M&A, anything. Here's the implied volatility for C Limited. And this is what we call an IV crush. So this was after earnings. So the peak here, this was the day before or the day on earnings. And as you can see, the front expiration was almost at 100%. Okay. But then the next day when the report comes out, there's almost always an IV crush. Okay. Unless the stock, rallies 20% or drops 20%, you're going to see this IV drop because everyone's in a rush to sell their calls and their puts. So that drives down the price of these options. And this is a really good opportunity for option sellers to get in. Now, of course, you open yourself to risk because, before earnings, there is a lot of, anything can happen. A company can announce bad earnings, like Intel, sold off, 30%. And as you can see, it's something else I want to mention as well. It will be the sort of the front week or the front month, which has the highest implied volatility, because in this case, November 27th, when this screenshot was taken, the earnings would have been around November 27th. And as you can see, the further up, the less impacted the options are because they're not sort of around the earnings period. Okay. And so here's an example of IV crush and how it can impact your trades. So if you were to buy puts on Salesforce, they had a disappointing, well, actually, I think if I recall, they had a pretty decent quarter, but the market was sort of selling off and the stock fell 4%. And yet the puts still declined in value. You can see the out of the money puts declined by 80%, 85%. And it's only in the money where it actually gains intrinsic value that was profitable. And yeah, you can see the implied volatility here for the front week went from 120% down to 55%. So the value just plummeted. So term structure as well. This is a term you'll be familiar with if you've sort of dealt in futures. So term structure tells you what the implied volatility is across expirations. And so if we look at today, so this was for, again, this is for Salesforce when they had their latest quarterly earnings. And as you can see, the most impacted is the front week. The week is the week which the earnings are actually announced. And you can see the front week is impacted the most, whereas sort of the yearly, the LUIFS are almost not impacted at all. And you can see that in the options chain as well. The out of the money puts actually gained value as opposed to losing value of the front week. So the front expiration is always most susceptible to implied volatility. Here's Zoom. So this was taken yesterday, and notice this for term structure for Zoom. Notice that the June 18th expiration has a spike in IV. That's because Zoom has earnings around that date. So this usually tells you. So if the market is expecting sort of moves, that's usually reflected in the term structure. And of course, we have to talk about GameStop. Something surprising, even though the stock rose, this was, I forgot which day this was, but this was at a point when it was trading at $120. The stock it rose 18.6%, yet the out of the money calls went down. And why is that? This wouldn't make sense if you weren't paying attention to the implied volatility, but as you can see here, it's because the IV went from 600% to 500% down to 470% for the front week. And why is that? Well, because the daily returns or the volatility couldn't keep up with previous volatility. Okay. And so, yeah, the options value goes down. Battery day for Tesla, same thing. The battery day was announced, well, the day prior, it was on September 22nd. And the day after, it was September 23rd. And again, as you can see, the market was expecting a lot of moves and a lot of people were buying, speculating, buying puts and calls, whatever. And yeah, so the implied volatility went from 160 down to 110%. And as sort of you approach the expiration day, the weekly, the IV goes down to almost 0% because again, it's to do with probability. So it's the probability that the option will be in the money. And we have the IV skew as well. So not every strike price will have the same implied volatility. The IV changes as you move across the strike prices. So when you see these figures here, for example, at term structure, that's the IV there, that's at the money. Okay, and here we're looking at the NASDAQ ETF. And sort of the puts, the out of the money puts will always be more expensive, especially on indices because people buy them to hedge, and that's reflected in the IV because it's more expensive. And either people are speculating that the market's gonna have a downturn, or it's more often to do with want to hedge your holdings. Now I want to talk about convexity, which is the exponential return you can see in an option. Now there are entire hedge funds which is set up around sort of buying these cheap options, and then sort of speculating on a sort of 2 sigma, 3 sigma event happening. And so we call this tail risk. It's betting on the unlikelihood. And so this was for GameStop. This was when it first sort of rallied. When the the stock actually, it opened up at $42 and it closed at $65, which is only a 55% return. Yet the options rose by almost 25,000%. The options, as you can see here, on the day they opened at $4. Okay, it says 4 cents here, but because of the multiply, the actual money you pay, $4. And the bid and ask went up to $980. Now, to get maximum convexity, you have to buy sort of the call or the put. You can get convexity on the downside as well. You would have to buy it by way out the money, and it has to be closest to expiration because that's when the options are cheapest. Okay, and that's how you can get that maximum convexity. Now, this is a theoretical scenario. I want to show you convexity sort of to an extreme extent. This is Visa. And suppose we brought 500 contracts for strike price $220. Okay, you can see here it's trading for, the bid and ask is at $2, $3. Now look at the pay and out graph. If the stock goes up 1%, you've made $5,000. And if the stock were to go up 5%, you've made $170,000. And if the stock were to go up 10%, then you've made $672,000. And again, that's from your initial outlay of $1,500. Because remember, each option gives you sort of the right to own 100 shares. So there's 500 contracts that we're buying. That translates to 50,000 shares. And the convexity really comes from being able to buy these options at such cheap prices. And again, this snapshot was taken yesterday for Visa for the weeklies that are expiring today, basically. Yeah, so let me break out the broker. Yeah, you've got all your supply volatility related content here. And you've got the options chain as well. See, we've got weeklies. These are expiring today. We have April 9th, which is expiring next week. So you have weeklies, and then you get into sort of the monthlies and then the quarterlies. The weeklies, the ones closest to expiration will be the cheapest because it has less time value, because the probability that these options will be in the money is so low. Now, if we go to sort of a year out option, look at that. These options are going for 5,000. It's going for 5,000. The current ask here is 5,500. Let's talk strategies. Direction strategies are, just buying a long call or long put. You can also have vertical spreads, which is same expiration, but buying a call and then selling a further sort of dated call. And let's just show you an example of that. So here we have Netflix. And let's go to the April 16th expiration. And we will sell the 555 strike, and then we will buy the 565 strike as well. So remember, this is for the calls. Calls on the left, puts on the right. Let's have a look at the profile. And so, yeah, like you're receiving $410 in premium for selling this option. And then to hedge, to cap your loss, you're buying the 565 strike for $269. So again, here's your example. And you can inverse this as well. So you can buy the, 550, and then you can sell the 565. Okay, and notice your initial outlay is $312, and your profit potential here is $1,188. And the good thing about these spreads is that it takes away sort of from the vulnerability of time value, and you're not as susceptible. And yeah, it's almost a binary sort of outcome. Like you're either, it's either in the money or out of the money. You're either making your $1,200 or you're losing the cost of the premium. Let's see what other strategies we've got. Yeah, we've got a calendar call. This is sort of, it's almost like a neutral bullish strategy. It's not too aggressive. And this is where you sell a front month call option, and then you would buy the further dated option at the same strike price. And let's have a look at the payout graph. And so what you're looking at here is you're betting on decay. Okay, as the option is sort of decaying as the time goes by, then this option will be in your favor. And as you can see, if the stock is drifting upwards, then your P&L for this trade is it can go up to 200, 300. And if you're sort of willing to hold until expiration, then you'll be looking at around $800, $900. And so you can hold on to the position. You can sort of wait for the stock to move until it hits your peak, your maximum profit potential. But I wouldn't recommend it. It's usually sort of when it's in the money, when it's when the trade is at a decent P&L, it's probably prudent to close out the option. And then we have out of the money calls and puts, which we talked about for Convexity. And then we also have non-directional trades, which is these will be selling premium, obviously. So you have covered calls, and let's just show how this would work. So let's say I own, so we're looking at Netflix here. And let's say I own 100 shares of Netflix, and I'm prepared to sell Netflix at $550. Okay, and I press Control S, and now we've added 100 shares of Netflix into this trade as well. And so let's look at the payout graph. Yeah, so remember, you get your $530 from selling the call, and because you have 100 shares as well, your stock would ordinarily rise with the your stock will gain value, and so you're capping your profits at $550 because that's the strike price which you're willing to sell your shares at. And so the profit potential here would be $2,300. Most of that gain is from the underlying, but remember, you're still making $535. As I mentioned, this is used by pension fund managers to collect premium. It can be used by pension fund managers to sort of rebalance their portfolio in a way, and it can reinforce discipline because you're preemptively saying that if the stock reaches this price, then I'm prepared to sell it. And you think about, you're basically getting money just for setting a take profit, just for selling your shares. So it's pretty sweet. Oh, right. What else do we have? Cash secured put as well. Now, as we mentioned earlier, when you sell a put, you, as the option seller, you're prepared to take ownership. And so if we were to sell a put on Netflix, let's say at strike price, actually, let's go further out in time. So these are expiring May 21st, strike price $450. So by selling this put, we are underwriting the risk, and we're providing a chance for the put buyer to transfer their risk onto us. So all this is a transfer of risk, and you're underwriting this, the risk here. And so your P&L is, you're at a profit as long as Netflix doesn't expire at 450, rather as long as this option doesn't expire when Netflix is below $450, because then you'll be assigned those shares. And when you sell a put, you practically own 100 shares, and that's how you should think about it, because your exposure for selling this strike price $450 is $45,000, because each share would be 450. You times that by 100, that's $45,000. So that's your exposure. And that's why it's called a cash secured put, because you have the cash ready to go into the position. Now, if you didn't have the cash, you just sort of rack up these contracts. So I could sell 5 contracts instead of 1, and my P&L would be what would it be? It'd be around $2,500. Then of course your max loss, you're looking at $222,000. So I prefer to be cash secured, so I am able to sort of meet that obligation. I mean, if you have a margin account, which you would have to if you're trading, if you're selling and buying options, then you would have to have margin anyway. And so more or less, you could sort of take ownership of half the cash. So, but that's if you want to be that leveraged. You have straddles and strangles as well. Straddles are very popular with volatility traders.
A straddle is opening an at-the-money call and put at same expiration. For a long straddle, you pay for the calls and puts, so it is a debit position. Since you're long, you want these option values to rise. One way is if the implied volatility rises. Now the long straddle would also benefit from moves in the underlying more than what is priced in. Here we're looking at the JP Morgan options. Now if we combine the payout of both a long put and a long call, we'd get a straddle. And for this long straddle, our loss is capped at the premium paid. And because of this, we would have 2 break-evens. To find the break-even for the straddles, it's pretty much the same as long calls and puts as well. So here we would add the premiums on the call and the puts, and we would add that to the strike price. And we would get the break-even for the call option to rise enough so that it compensates for the premium paid. Now with this long straddle, theta will tell us the daily decay that we can expect on these options. We'd experience a daily loss on the position if the daily returns isn't greater than how much the options decay by. And you can find how much the market expects the daily returns to be for the option. You would take the annual implied volatility figure and divide that by 16 because of the square root of time. And that resultant figure will give you the daily expected returns. And if the realized daily returns is greater than what's priced into the option, then that will be profit for you. Now a short straddle comes with theoretically unlimited risk. The position is both short and at the money call and a put, where the theta is daily profit, and the break even mention is where we need the stock to stay within a range. So we can say the position is range bound. You can go into these sorts of trades with a view on expected volatility. For example, long volatility funds brought a lot of long straddles at the outbreak of COVID at the start of 2020 before the March sell-off, expecting a rise in IV. And you can go long or short these straddles based on whether you think the current IV is cheap or overpriced. But this area very quickly gets quantitative. For example, look at the volatility estimator models by Garmin and Class, and also look at the volatility distribution functions. If you want to learn more about this area of options trading, you can check out Euan Sinclair's book on volatility trading.
Now, a strangle is when you sell at different strikes. So you could sell the 600 strike. Let's pick a delta of, let's say 20 here, 20 delta. And let's sell a put at 20 delta as well. And so since you're short both the puts and the calls, your profit potential here is $1,800. But because we've got 5 contracts, you multiply that by 5. And yeah, it's basically a straddle but with separate. You sort of widen, you widen the strike prices. And an iron condor would be you going in, and because you have unlimited exposure, because you're short the call. If Netflix rallies, if it gaps up, then you're going to be at a loss, and if it plummets, then you're shorting. Actually, you're long 100 shares, so that would be actual loss. So you can hedge it by going to let's pick a delta of 10, and then let's hedge our calls as well. Yeah, if you noticed here, our puts, that's hedged, and then let's pick a delta of 10. And so we're buying the call. And here's our iron condor. Yeah, so it's just a strangle, but it's capped. And you can do this sort of prior to earnings because you can expect the IV crush. And yeah, but the thing is, it sort of reduces your profit potential because you're having to pay for this hedge. So when we buy the 640, we're paying $355 rather than getting to keep the entire $800 in premium. But you got to pay for a hedge. And some notable trades. Let me just go back into full screen. Yeah, some notable trades with Walmart. 27th of August, they announced they're going to buy TikTok. Brought some calls, and the IV shot from 20% to 40%, and the stock rallied as well. So that was a nice profit there. Kodak as well. When the US government announced they're going to give a grant or loan of 600 million, the stock rallied from $2 to $60, 3,000% rally. Now, of course, you can't bet on these sort of gap ups, but you can still profit after there has been a rally. So in this case, I sold some puts at $5, which was way below the current stock price, and so I was happy to sell those puts, and I collected premium. And as the IV sort of decayed, as it went down within the span of a couple of days, I was able to close that position for less than I had brought it. And Netflix as well, I sold some puts. They had a disappointing quarter, and so I was able to sell some puts. And this is akin to selling the dip rather than buying the dip. So when you're selling the put and you go into a cash secure put, you're almost bearish neutral. The stock can stay flat. If that option still expires out of the money, then that's still profit for you. And AMD as well, they had a disappointing quarter again. September, there was a sell-off, and I went in some covered calls as well. Again, Battery Day, GameStop, and the 10-year as well. I managed to join in on the momentum as well. So that's for the bonds. And this is an example of a trade that was sort of on the news. It was quite big. And what the trader here did was he shorted natural gas calls. So he was trying to collect premium. And it just so happened to be that in 2019, the year when this trade took place, inventories of natural gas was very low. And so, you have low supply and there's high demand. The price of natural gas soared. So here we can see for the futures from $2.60 to $5, it doubled. Now this was a $150 million mistake. The hedge fund manager here, he didn't cap his short calls. There was no hedge, and there was absolutely a risk of ruin. And he downplayed the tail risk. Crazy. And the worst part about it is that it wasn't even his money. It was investors' money as well. They lost everything. They were actually in debt. His broker was calling up the clients to pay off the negative equity, and some of them had to sell their houses and stuff as well. It's bizarre, but yeah, I mean, look, the takeaway here is that it's options do provide a lot of leverage, a lot of profit potential, but at the same time, there's an incredible amount of risk, and you should know what those risks are. And I want to sort of introduce you to the idea of volatility being the only asset class. So in March, we saw pretty much everything sell off. We saw the equities, the S&P 500. We saw the finance sector, energy, gold, even Bitcoin, the commodities index, and investment grade bonds as well sold off in March. And so there's this idea that you're either long or you're short volatility. And ultimately, in times of distress and uncertainty, all asset classes tend to look the same. And the only thing that's guaranteed is volatility. And here we're looking at the VIX, which is the implied volatility for the S&P. Okay, so yeah, the VIX is usually known as the fear gauge or the fear index, and it tells you how much, what the market is expecting for the S&P to do. If you want to learn more about volatility as an asset class, check out Artemis Capital Management. They're a volatility focused firm, and they sort of, they say no matter what your investment or your portfolio type is, whether you're fundamental or distressed investing, or your 130 or 30 fund or currency arbitrage, you are ultimately short volatility. And yeah, their research is actually public, so definitely give that a look. And then yeah, we'll take Q&A. Any questions?
Cheers, Michael. That was great. Yeah, if anyone has any questions, feel free to unmute or just go in the chat and type in a question. I'll read it out. Cool. Who wants to go first?
I have a question for Michael.
Yes. Hey, Sammy.
Great great presentation. And I just have a question about the option chain. So, for example, I think that for some reason a certain stock is gonna fall. So let's use the one on your screen right now, Netflix, right? So I think it's gonna go to like 440, 490, let's say. And
Okay.
so I want to buy a put, right?
Yeah.
Because my thesis is that it's gonna fall. So what price should I sort of look for, as in the strike price? Should I buy one that's 470? Should I buy one that's 495? Because from my understanding is the more out the money your option is, your delta is higher. So when the price goes the way you want it, the more out the money your option is, the more money you'll be making because your delta is higher. And assuming everything else is constant, of course. So when I have this sort of a hypothesis in mind,
Sure.
and what should I like set my strike price to be when I have a directional trade there?
So the question of what strike to buy calls and puts is really a question of how much exposure you want, because the closer at the money, the higher the likelihood that the option will be in the money, but at the same time you're going to pay more for those options. So as you can see here, we're looking at Netflix again, carrying on the example, and the strike we're looking at is $510. At the time, Netflix is trading at $508. And have a look at the break even, it's at $497.25. And that of course is calculated by the strike minus the premium paid. Also notice that for a 10% drawdown on Netflix, our P&L will be $4,000. And now we're looking at strike price $475. Now the put here is a lot cheaper because it's further out the money. The cost we're paying is about $220. And therefore our break even would be calculated as the strike minus the premium paid. And so that brings us to our break even of $472.80. And if you compare that to the $497 break even for the at the money put, you can see why closer in the money puts are more attractive. Now the trade-off for having this more attractive break even is that we're paying more for the at the money puts. You should also consider how much you expect there to be a pullback. So if you would expect, part of a support and resistance pullback, which, you could sort of expect it to be within the 5 to 10% range, then yeah, you may be better off buying an at the money puts. However, if you expect sort of a black swan, if you expect a really nasty drawdown, we're talking 20-30%, then you may be better off just buying out the money puts, because that's where the convexity comes in. For example, looking at our 470 strike put, our outlay is only $220. So we're free to rack up the number of contracts if we want a similar exposure to the at the money put. So having a look at this payout graph for 5 contracts, you can see that a 10% drawdown would give us a payout of $10,000. And likewise, a 20% drawdown would give us $33,000. And this is really what makes puts more attractive than just shorting the stock. Because one, because of the convexity. For example, notice that the delta is how much dollar the contracts gain for every $1 down the stock goes. So currently the delta for the position is 66. So for every $1 down, for every $1 the underlying goes down, you're looking at $66 in profit. And as the stock is drawing down further, the delta is rising, which means the position gains more for each $1 drawdown.
You could also go into a bear put. Okay, so rather than just buying the put naked, you could buy the 520 and you could sell the 500. And so you're paying $750 and you're receiving around $290. And so this sort of caps you're not as susceptible to time value because you're receiving premium. And as you can see with theta as well, it offsets the theta from 0.375. That's what you're losing, but then you're making 266 a day on the theta, and so your net theta exposure, which again is time value, is reduced. And as you can see, this provides a pretty decent profit potential. And so if you had like a price target, if you wanted to be more accurate, yeah, you would go with this strategy. And so the short put with this bear put is usually the price which you think is going to be at. So here our short put is 500, and yeah, as you can see here on the payout graph, if it were to reach anywhere near 500, as of today, like if we went into a position and the stock went down to 500 today, we would make around $780 on that trade. And if we were happy to hold it until expiration, as you know, as time goes by, let's sort of put it to expiration, well, you already know it's the solid line, so you'd be making full profit. So again, it's the flexibility that comes with options, and it's your view. How do you want to express that? What do you want your exposure to be? How much do you think the market's going to move? And these are things you should take into consideration.
Okay, thank you. Just a quick follow-up. So let's say, because in my mind, I was thinking of like, the more out the money you are, the cheaper the option price is. Is that correct?
Absolutely, yeah.
So when the stock price is moving in your favor, if I buy a more further out the money option, I would potentially earn more percentage-wise?
Yeah, because, well, the reason you would make more is because you're buying more, because of how cheap it is, right? I mean, let's go back to that. Yeah, but like, let's go back to that 400 strike. If I'm just buying one contract, like, you know, the payout is going to be abysmal. You know, we would need quite a big move if the stock were to decrease by how much? By 20%, right? You'd be making 1,000, right? Which is not a good. Yeah, there's no reason to buy just one. If you're buying these penny way out the money contracts, then you should definitely load up on a number of contracts, because that's how you get that, you know, that real convexity, and that's how you take advantage of the 10,000, 20,000% return on these options.
Okay, I see. Thank you.
Yep. Good stuff. Does
anyone else got any questions?
I mean, here we're looking at the portfolio. This is actually a demo account. I don't really use this, but yeah, Interactive Brokers, I recommend it. It's a really good broker, and you know, it gives you exposure to the US markets and pretty much any other markets as well. You can trade bonds, of course, options and stocks as well. And yeah, here you can see I'm short sort of Tesla, puts, Square, AMD as well. And so far the P&L on this is around 1,700. And this is calculated by the cost basis, i.e. how much we sold it for. So altogether we sold it for around $3,700. And the market value is around $2,000. And so that difference, that reduced in value, is our profit.
I have a question. What is the most vanilla, safe trade you could make in options where you're like, you know, you got a reasonably high profitability of success, but there's like, you know, low risk?
Yeah, it's a very prudent question. I would say it's covered calls and cash secured puts. So yeah, if you were happy to buy the stock, you know, the strike price which you sell the put at, that can be your limit order. Okay. And rather than sort of entering into a trade as at the market price, if you want to take ownership of the stock at whatever strike price, yeah, you would sell at whatever strike price. And of course, the closer in the money, the more premium you're collecting. And with covered calls, it's like you already own the shares. So, you know, why not sell some calls? But of course, you are sort of capping that profit potential, and you do have to bear that in mind. And actually, since we're on the topic of covered calls, there's sort of a cost-efficient way to go about doing that as well. Like rather than buying 100 shares, what you can do is you can buy a leap. So these are long-dated options. Okay, so this is expiring June 2022. And let's go deep in the money. We want a delta of around 90. So this is very closely mimicking the stock. So for every $100, or rather for every $1 move in the underlying, then the option will gain 90 cents as well. And so if we were to buy this, okay, and then we want to sell the April 16th call options. And if you were sort of neutral to bearish, maybe not too bearish, but you could sell at the money calls. Now, this is obviously capping your upside, but it's also getting maximum premium. And so, yeah, you could potentially get $1,000 in premium. But it's if you do see profit potential on the upside, it's good to give it some breathing space. So you could sell it at whatever strike price you want. So you can sell at 560. And now let's have a look at the payout graph. And as you can see, it's very, very closely mimicking the covered call of buying 100 shares, whereas our exposure is, what is it, 21,000 that we're paying for the in the money calls. So this is known as a poor man's covered call, because of the cost efficiency of going about it. I've done this trade quite a bit. It's not too bad.
Class, cheers. And then I've got another question, which is like, obviously on equities, you normally see the price like range. So it might bounce between, say, like, we'll just do a theoretical stock here, say between 300 to 330. And the past 2 months it's just been bouncing around in that range, So I'm just wondering is there an ability to be able to set up an option position where if price breaks out, so the underlying breaks out, either above 330 or below 300, where you'd make money, but if it's still bouncing in the range, then obviously you're down money. Is there a way you could kind of like set up a position that kind of like, is almost like a range play? You don't know which way the range is going to break, but if it does break, you make money.
Let's say Netflix is trading within a range of, I don't know, 560 and let's see. And 505. You would, let's put that to a buy actually. So to have almost sort of a binary outcome, you would sort of sell a little bit further out the money, put some calls as well. And so let's have a look at the profit profile here. And so you see here, if it's stuck within this range, you're not making any money. But then if it's outside of this range, then there's your profit potential. And this is actually a pretty decent trade because your return to risk for every $1 you're risking, you're making profit potential of $3.81. So yeah, you could go long an iron Condor.
Class, thank you. Okay, cool. Is there any more questions? I just noticed that we're like at 4 o'clock now.
All good stuff.
All good stuff, mate. I think you've stunned them all. They're all like processing all of that. So I want to thank you. I want to thank you for coming on and doing that session. That was great. If anyone has any more questions, obviously just send Michael a message. And then, yeah, I mean, what's next for you, Michael? You're going to be trading full time, right? After your degree?
Yeah, pretty much. We'll see how this year goes in terms of returns and stuff. Last year was very profitable, pretty good returns. And so we'll see how this year goes as well. And I might start taking on money. So should be good. But yeah, I would say thanks as well for hosting this and stuff and putting it together. It's been great.
Yeah, hopefully that was useful. Thanks again to Michael for putting this on. I'm still so impressed the fact that he's doing law. He's not even in finance, not even in LUMS, and he knows all of this. So credit to Michael, and yeah, hope to see him make some sort of firm in the near future. And I think it'll be class. All right, cheers everyone. I'm going to hang around in case there's any questions or any other admin bits regarding the fund or any stuff. But everyone else, just feel free to drop off if you haven't got any questions. Thanks.